Welcome everyone to the 39th Annual Eide Bailey Bankers Seminar. At this time, I'd like to recognize our partners and our associates of Eide Bailey who support this event. I'd like to have all those individuals, if you're in the room or if you're still out in the lobby, if you could stand up and we can give you a round of applause for helping out today. My name is Shane Husar. I'm a partner here in our Fargo office, and I'm excited to be one of your hosts. Our motto for today's event is Expanding Horizons, Planting Seeds for Success, and we're very excited for all of you to join us. Uncertainty seems to be one constant we can count on these days, whether that comes in the form of local market dynamics or global economic factors. The result is the same. Community bankers must continue to be the leaders in being adaptable to changing business environments while still holding true to the values that make our services exceptional and distinctive. What's important for all of us to remember is that uncertain times do not mean a lack of opportunities, and change moves ahead with or without us. Now is the time to be thinking strategically about the future of your bank and plant those seeds that will position you for success. We invite you to join Eide Bailey and your peers at our seminars, where we will talk about the different ways you can expand your horizons when it comes to your industry and your organization. We appreciate your attendance today and look forward to having so many of you here to interconnect with your colleagues, friends, bank regulators, and professionals in the banking industry. During today's seminar, make sure to connect with all of those individuals and make sure, more importantly, that you connect with our speakers and our panelists to further the conversation on the topics presented to you today. All right, before we get to our keynote, I'd like to extend a very special thank you to Cheryl Knudsen, Sandy Sale, and Sherry Bittner, who have spent a considerable amount of time planning and organizing this event. Can we all give a round of applause to those three? As well as our Eide Bailey support team and Mobile Pro for providing the technical assistance today. These individuals really make this event a success. We'd also like to extend a thank you to the Delta by Marriott management and staff for their great service and delicious lunch. This is our second time now having hosted here at the Delta by Marriott, and it's been fantastic. So as I mentioned, our theme for the Eide Bailey Bankers Seminar this year is Expanding Horizons, Planting Seeds for Success. And with that in mind, we have brought in speakers and thought leaders who will help you soar to great success and prosperity. To keep us all connected, we'll be using text and polling technology today during our regulatory panel. So this is the part where we all pull out our cell phones. So to start things off with our phones pulled out, we'll start with a polling question to survey the audience. And so how we get access to that polling question is you're going to text 22333. And you'll receive a response back, and it'll confirm your attendance. And it might not say Eide Bailey Bankers Seminar, but if you type in 22333, I promise you it's ours. It's not some phishing scheme. And our first polling question is, how long have you been in banking? And so all you have to do is text the applicable letter that is next to the different categories, and you should be able to see live what the dynamic is here within the industry and within the room today. Is it working? I can't see anything you guys are seeing, so. Where are we at, Gary? Who's got the lead? Okay, mostly 10 to 19 years, all right. Old enough to see a few things, but young enough to where we probably haven't seen ag conditions like we have this afternoon. What? So the plus category, the 40 plus year category. Is that you, Earl? There you go. All right, our next polling question is, what is your primary role or title within your bank? Okay, let's give it a second. I'll give you the answers or the responses here. So A, if you're the CEO and president. B, if you're the CFO or in the accounting department. If you're the COO or operations, pick C. If you're in lending, pick D. If you're in compliance or internal audit, pick E. And if you are in HR or a supervisor or manager, pick F. All right, so majority of us are lenders, and I'm guessing are very excited to hear what our keynote speaker has to tell us today. All right, with our last question, we'll do one more here, and then we'll move on. Let's talk about the issues that are facing your institution, and what are some of the hot topics that are of interest to you. If lending concentrations is one, pick A. If succession or staffing issues is primary concern, pick B. Burden of regulation, pick C. Ag economy, pick D. Banking, legal, cannabis, and industrial hemp, pick E. Or business analytics, pick F. I'm guessing it's got to be ag, right? Ag's got to be the heavy concern. Yep. So how's that for a perfect segue, huh? All right, let's lead into our keynote speaker. And if there's individuals that are looking for CPE in the room, if you are connecting with our mobile application, what you would do is you would go into that specific breakout. So in this case, it would be our keynote. Go into that session, and there will be a link for CPE. And when you click on that link, you'll enter in a check-in code, and you'll put in a specific word. And that check-in code, for those that are taking CPE, is business for this specific session. It's business with a capital B. And we'll give you the checkout code at the end. All right. World trade and agricultural products are under extreme stress. Markets, prices, and trade are now more volatile than at any time in recent history. Government intervention in trade and marketing has escalated sharply and is far greater than what the industry is accustomed. This presentation describes the evolution of these trade interventions, particularly the Chinese trade war, but also addresses the status of other trading regimes. The implications of these on prices, exports, and stocks are discussed. Focus is on the upper Midwest agriculture sector, and potential outcomes will be presented. Now, I'd like to introduce our keynote speaker for our general session today, Dr. Bill Wilson. Dr. Wilson was named Distinguished University Professor in 2007 and is a professor in the Department of Agriculture and Applied Economics at North Dakota State University here in Fargo. He has been working in the areas related to grain marketing, transportation, and logistics. His academic teaching covers these topics at the undergraduate and graduate levels. His research program at North Dakota State University is focused on grain marketing, transportation, international trade, and marketing logistics. In these capacities, he has had numerous awards, has served as a guest lecturer around the world, has served on the board of directors for the Minneapolis Grain Exchange, and has provided advice to numerous international companies and countries on related issues. Please join me in welcoming Dr. Bill Wilson.
Thank you. So good to be here. If you're taking this for credit, we'll have a test on Tuesday. Okay. Actually, I have a test on Tuesday, so it reminded me of that. So my area of academic training and what I do all my work in is what I call risk and strategy. So we talk about risk. What we do is quantify risk, and experience in agriculture is really risky, and what we try to do is quantify risk and then evaluate how effective different strategies are for reducing that risk. On this topic, I'm not really a world trade expert, but I do work in about 11 countries around the world. I travel internationally 1 week a month, and so I'm pretty knowledgeable about what's going on around the world. I don't consider myself a trade expert, however, but I'm on 5 boards of directors, and the events of the past 2 years have had a either extremely negative or extremely positive impact on these companies, probably ranging from $1 million to $50 million a year. And I saw on the screen here where you said agriculture is by far the most important topic, so hopefully I'll shed some light as to these developments. You know, this is changing very fast. I read about 7 newspapers a day before I go to the Y to work out, partly because you have to read more than one newspaper to get the truth, or what you think is the truth. And things are going on very rapidly around the world. What I want to talk about today is just give a little review about how important ag is in this region of the country in particular, and some of the radical changes going on in world agriculture. What are the impacts of these trade wars on prices? I want to talk about the evolution of this trade war the best I can and the current status of it. And then I'll finish by summarizing what the impacts are on the ag sector and the farm sector in this part of the country in particular, and the agribusiness sector. But I'm sure everything will change by Tuesday, so don't worry about the test, okay? So when I speak, you know, I started speaking on this publicly in the late 2000s, and there's a lot of pretty phenomenal things going on in agriculture, and I'm not going to elaborate on all of these, but they include the 9 billion people problem. Means we got a strong growth in demand. We're having radical changes in the geography of agriculture within this country and internationally. We're having extreme interventions in the marketplace now by China, really now by China, the United States, Russia, and other countries. We have increased differentiations in demand, including organic and non-GMO and genetic editing and all of these things. We're having pretty sharp changes in the logistical environment, in part because of ocean rates, Panama Canal, Suez Canal. We're having a tremendous revolution in agriculture technology, which gives us in this country a big advantage relative to other countries. We've had an increase or escalation in risk in agriculture, the agricultural economy, particularly farming and the agricultural businesses. Risk is about doubled since 1980. So we quantify risk. The level of risk today is about twice as great as it was in 1980. So this is my world of agriculture. If we start on the upper left, we got the role of Russia and Ukraine. We got the new president and now another new election in Argentina is pretty important because they tax exports of agriculture and they're under pressure to reduce those. We have the US and Canadian under NAFTA becoming really one economy. We have changes in soybean flows and the escalation of Brazil. That's just a snippet of what's going on. But just briefly, I think it's very important. I'm very heavily involved in Russia and Ukraine. It's really important to understand the impact of Russia and Ukraine on what's going on here. This was a new Bloomberg article in 2010. And it was in May of 2010 in particular, and they were talking about the growth of production and exports from Russia and Ukraine, and how they're reverting to become a major potential agricultural exporter. That was May of 2010. June of 2010, they had a very severe drought. They put an embargo on their drought, and our prices went up $1.50 a bushel. That's how quickly it changed. But that's how important they are. And this shows the level of exports of wheat over time since 2000 until current. Today, it's significant that Russia, Ukraine have 40% of the world wheat market. In 1991, they were an importer. They were one of our biggest customers. Today, they're 40% of the world wheat market. They used to export only to the neighboring countries, then North Africa and the Middle East. Now they're exporting into Asia and into Mexico and other Latin American countries. So they're having a big, big impact on this. And Putin, he's pretty excited about agriculture because now agriculture foreign earnings exceed that of selling defense armaments around the world. Here's a Newsweek article, Ukraine, getting ready to double their grain output. This is probably one of the most drastic changes that we were experiencing, at least in my career, in these countries. But the impact of that, we have extreme competition in agriculture, more so than ever before. And this is because of the growth in these other countries. And the result of it is that really in international trade and competition, all trades are within pennies per bushel on a landed basis. The impact of that means those countries that have an advantage will gain that advantage if they have better quality, better logistics, and seasonal supplies. So compounding all of this is the role of China. China, as you know, is a government-run country. But in 2012, they said, we need to have our own Cargill. This was a Bloomberg article. It says Chinese want their own Cargill. And they didn't want to be dependent upon what we're commonly called at that time ABCD, Archer, Daniel Midland, Bunge, Dreyfus, and Cargill. So they created their own entity called Kavco, one of my biggest employers of my students. And their intent is really to be less dependent on the United States and Western countries and do their own international trade and marketing. I'll come back to the significance when I get to China. So a punchline that I want to leave for you as bankers is we as the United States are, generally speaking, for most all of these commodities, a low-cost producer. So we have an advantage when we don't have trade interruptions. And that advantage is due to our supply. We're a big producer. Due to our logistics system, which has evolved over the past 30 or 40 years. And every other country in the world is trying to copy what we do because we do that so well. And it's due to our ability to differentiate our products. And that is combined with the fact in the last 10 years, we have a tremendous amount of new technology being invented in agriculture. You know, drones and precision agriculture and genetic editing, to name a few of the types of technologies. Now we're going to be talking about autonomous tractors and autonomous farms and satellite imagery. All of that was invented in this country, which gives us an advantage of 4 or 5 or 7 years relative to all of our competitors. So that should suggest we should have a booming agricultural economy. But when we get the types of trade interventions we're experiencing now, it takes what would be our competitive advantage and really has a bad impact on us. So that's my punchline on this slide. So soybeans, and I'll talk about soybeans, China, and Trump in particular. Who's going to win that? Very simple, it's Brazil. So here's the significance of China. That red line shows the growth of China imports of soybeans from the early 2000s till current. So historically, most countries' growth in imports is about 3 or 4% a year. This is 18% a year. It's by far the biggest importer of soybeans in the world and the fastest growing importer of soybeans in the world. We want to be there. We've typically dominated that market, but we want to be there. You can see it tailed off here in the end due to African swine fever, which I'll speak in a moment. But people who do a lot of fancy projections prior to the trade war had this going up to about 125,000 metric tons, 125 million metric tons a year, okay? So you can't talk about soybeans in China very much till you use the word Brazil, and here's a couple slides on Brazil. And the top slide shows the rate of exports from Brazil. So you can see in the early years, you know, they would export 1 or 2 million tons a month, but in more recent years, it's up to 5 million tons a month, and more recently being expanded to 7. Well, the impact of that is that now instead of exporting 12 or 14 million tons a month, a year, they can export 50 or 60 million tons a year. And the bottom slide of this shows something called wait times. And this is very important because they have a constrained logistical system. Ships show up waiting for a load of soybeans. Trucks are waiting in line to unload them. And this shows the average wait time, which in some of the years in some of the ports can be 20 days at $50,000 a day. So it's a very serious constraint on their system relative to ours. The impact of this is that over time, the world marketplace has evolved so that the United States harvested soybeans in September, October, really exported and dominated the Chinese market from October till January, February. Brazil harvested in March, exported until June or July, and then we fought over August who dominates that market. And you can see that in both of those slides, which shows that extreme seasonality. So when all of a sudden China can't buy from the United States, they have to buy everything from Brazil year-round instead of over a 4 or 5 month period. So that has a dramatic impact on this. Here's how important China is. This shows our exports from the United States of soybeans. That first bar is China. The next one is the EU. We would, not having China, we would have to have more than 100% of every other country, and we would still be exporting less than we are today to China. That's how important China is. I say that because sometimes we get wisdom out of Washington and say, don't worry about it, sell to other countries. This says there's not many other countries. We export 95% of our soybeans from this state to through the Pacific Northwest and Portland. That first bar shows that world exports from Portland, Pacific Northwest, to the world, and then to China, and then all the rest are all of the other countries. Virtually nothing. So if you take away China, the Pacific Northwest really dries up completely, which is the market to which we do all of our exporting to. This is China. This is exports for the last 5 years to China, the first bar, and then all of the other countries. And you can see how severely reduced the exports are going to China. And the other countries really haven't picked up the losses that we've accrued to China. So this says in February 25th, 2018. So as I think about the evolution of trade war, in October of 17, Trump was talking a lot about needing to negotiate better terms of trade with China, and that tariffs were his friend, and that trade wars are easy to win. That was October 17th. In February 2018, the Chinese put out this press release, which was their way to communicate, and said, if you impose a duty on Chinese imports in the United States, we're going to retaliate, and we're going to put duties on imports coming into China. So it's crystal clear in Washington what they will do if we impose tariffs. That was February 28th. Lo and behold, they imposed those import tariffs anyway. And I just want to point this slide here because it shows the massive amount of storage. What's happened in this marketplace is soybean prices have fallen, but the spreads between different months have increased to record high levels. So that induces storage. So one of the biggest businesses in agriculture in the Midwest today is building new storage. Whether you're an elevator or a farmer storing in these white bags because it's so profitable to store. Ironically, every other country in the world is selling their brains out, and we're storing. That's what the effect of this has been. This shows the prices. This is in Jamestown. This is a class exercise. But that red line on the left shows the normal basis in Jamestown. And you can see it falls during harvest time. And this year, the basis is about $1 below what it normally is. So when people talk about the price impacts, it's most of the impact on the futures market, about $1.50, an impact on the bases, about $1 to $1.50. So it has a big impact in this part of the country. Now this is Gavilan in Jamestown, and you can see how that basis falls very sharply there. That was in July of 18 when the tariffs were announced. So it just forced their basis down to extremely low levels. It's increased somewhat now, but it's not regained its previous level. One of the things that's happened that's kind of favorable, and this is the basis at the U.S. Gulf. When I say basis, I guess maybe you may not know, that's the difference between the cash price and the futures price. So this is the basis of the U.S. Gulf and the Pacific Northwest, and you can see that gray one is the Pacific Northwest. Typically that's higher than the U.S. Gulf, But during the course of the past 9 months, the basis of the Pacific Northwest has come down, and that the U.S. Gulf has gone up because of the flooding on the Mississippi River. So it's made the Pacific Northwest on paper very competitive relative to the U.S. Gulf. Here's the basis in Brazil. So you can see on that left side, that solid red line, that's their normal basis behavior average. Their basis is abnormally low during the period of time Jan, Feb, March through May, and then it escalates to a high level. And this is really critical. I don't have today's market on this slide, but I'll tell you, if you're bankers and you're financing holding of soybeans or farmers holding soybeans, we're getting fairly attractive prices now, but after the new crop harvest in Brazil, which is February, March, that number will go down by $1 a bushel, which ultimately will force our numbers down by the same amount. So what are the impacts of the Chinese tariffs? 25%, that translates to about $1.90 a bushel. That means delivered to China, our prices are $1.90 out of the market relative to Brazil, or Brazil has $1.90 a bushel advantage relative to ours. A component of this, which is really important, is the role of government purchases, because China is really a controlled economy. They have two agencies, one called CAFCO, one called Sinogreen, which are government agencies, where the government finances all of their capital requirements and make sure that they aren't exposed, they protect their risk on the downside, which gives them advantage relative to us. All of the purchases that have been made so far have been made by those two agencies, so the government waives the tariffs of those government agencies. But for the private crushers, about 40% of the market, they don't have that advantage. So these lines here, the top red and blue one, are delivered prices to China from the U.S. Gulf and the Pacific Northwest. The lower gray and amber one are delivered from North and South Brazil to China. So you can see the advantage that they have relative to us. So that's how dramatic it is. I've been involved in this since the beginning of time, and I have to speak to it frequently, and I would say one of the most devastating impacts was this particular news article from Bloomberg in March of 2018, just after the Chinese said they would retaliate, and they said, don't worry about it. They have to buy our soybeans. You know, I've been in agriculture a long time, and nobody has to buy our soybeans or any of our crops. We don't have a monopoly on anything, and it's getting less of a monopoly than ever before. But this is significant because it told Washington and our congressional delegations, you know, if they want to have a trade war, don't worry about it because they have to buy our soybeans anyway. Well, as it turns out, they don't have to buy our soybeans. There's a lot of detail here, but I want to highlight a few numbers. The top yellow line shows the Chinese imports up at about 100 million tons a year, now to about 84 million tons. Brazilian production to about 121 million tons, of which they export about 80 million tons, of which 95% now goes to China. And China can buy about 20 million tons from other suppliers, Brazil, Uruguay, Paraguay, Argentina, Ethiopia. And you take all that together, they don't have to buy any soybeans from the United States. So that's really a significant fact, and I think it's important for us. And as we look at the soybean market, I'm very concerned about long term. CAFCO, the Chinese agency, says they will expand production domestically. They'll increase their purchases from South America and elsewhere and shift to other types of oils other than soybeans if they have to. They're expanding production in Brazil, Ukraine, Russia, Far East. Wall Street Journal has an article just coming out, I think today, I read it yesterday, talking about the Far East development, because that's connected by a land bridge to China, and they're targeting growth of that. There's not enough Russians there to support civilization, so the Chinese are leasing the land longer term as a source of soybeans. We've analyzed this pretty heavily. We don't think it's going to be viable at all, but it doesn't stop that from helping. They're even importing soybeans from Ethiopia. There are 8 new port projects in Brazil at about $500 million each, built by Cargill, China CAFCO, Louis Dreyfus, Glencore, and ADM. In the United States, there's none. And Russia is very important. This is the headline. Russia offers 2.5 million acres. So Putin offered farmland in the Russian Far East to the Russian farmers, they all turned it down. So he's offering 2.5 million acres to the Chinese if they can develop it into a source of products. Concurrent with all this is this thing called ASF, African swine fever, which is very, very devastating. And it's in China. That line chart on the right-hand side shows Chinese domestic production and consumption of pork. That red line is pork. So just about all, like 80% of their protein consumption is pork. And with this Asian swine fever, African swine fever, the production domestically is going down in the area of about 30%. Okay, so that means their demand will go down from about 100 million tons to about 80 million tons a year. Now, I'm on 2 boards of directors, one of which is very much impacted by this. In the last board meeting we have in July, we had an expert speak about this. We have another meeting on Friday. And the expert told us this will last a long time because the geography and the agronomics of Chinese farms, they're small family-held farms where they might have 5 or 6 hogs in their backyard. So the ability to control a devastating disease like ASF will be very difficult. So this will have a longer-term impact, not only on China, but it's creeping into South and North Korea and into Poland and some of the East European countries as we speak. So this is their trade press saying that their imports would be down 20% because of this disease. So this is one of my slides. It's probably one of the most popular slides when I speak about this. We have a commodity trading room at the university that I use, and we have all of the sources of information. So these are trade flows. And every one of those dots in white is a ship on that particular date shipping soybeans. We can do this for any commodity. These are soybeans specifically. So the top chart is 2016. And you can see we got soybeans going out of the west coast of the United States, out of the Gulf, some going through the canal, some going around the Cape. We got a lot of soybeans going out of Brazil, going to China, and going to Northern Europe. So you want to see the effect of the trade war. The bottom chart shows that. You can see we have virtually nil exports coming out of the United States. Brazil's ships are escalated sharply, going direct to China and to Northern Europe. So this is the effects of the trade war that we're currently experiencing, probably in one slide. Okay, so current numbers on these charts here show exports of soybeans from the United States on top, and on the bottom are the Pacific Northwest in particular. The black line is the current year. You can see out of the Pacific Northwest, we should be in peak period for shipping soybeans now, and our exports are close to nil. So that's how devastating this is. So they always ask, and your bankers are you going to ask, how long is this going to last? I get this asked all the time, and I give an answer, and I get challenged by it, but I'll give that answer again, and I'll tell you the reason why. My answer is it's probably going to last 3 to 5 years, okay? Here's the reason why. This is USDA numbers from the Outlook Conference last February, and that bar chart shows the level of stocks in the United States. Normally, we have stocks at about 5 million tons. This year, our stock level will go to 25 million tons, which will be an anchor on top of the price market. This is USDA projection on the far right-hand side. It shows the stock use ratio, and that red line, the dashed line, is the stock use ratio. Normally, it's about 5%. I'll show that in a moment. As a result of the trade war, we're at about 25%. So over time, we will reduce production. Demand will go up and eventually it'll go down, but this says 4 or 5 years. That's USDA's number. So this is a chart I use in my class. It shows on the vertical axis futures price levels. Horizontal axis is the stock use ratio. So you can see normally we have a stock use ratio of 5, and that results in a price in the futures market of 10 or 11. As a result, initially of the trade war, that was going upwards to about 25, which would spell a price level of about 7. Now, because of the crop problems we've had in this country, in particular, our stock use ratio this year is probably going to be about 0.11, which would suggest a price about $8.50 to $9, down $1.50 relative to where it should be in a normal year, suggesting this will take 3 or 4 or 5 years for it to be mitigated. So what I'd like to do now is speak to the trade war. So I don't want to give any impression that I'm bashing the administration. However, and so you know, I was a Trump advisor during the election, and I gave a speech to the Trump campaign in June of 2016 as an expert about agriculture. And we were identified along with 7 other major industries that they wanted to have advice on. And I said, don't mess around with ethanol. Agriculture is pretty good. Don't mess with ethanol. It serves an important purpose. Don't mess with China. They're important in all of these markets. Fix some of these regulations that are bad on us. That's what we told them. Now, that's not exactly what's happened, but that was going into this. But I have to articulate what's happened. Commencing in 2017, the administration started talking about trade wars, and they've ultimately chose to pick multiple battles all at one time, not only China, but also Japan, EU, Mexico, and Canada. And in each battle, and it's very careful language, they justify intervening and imposing import tariffs based on national security. And that's the magical word, because that allows the administration, without approval of Congress, to impose tariffs. If it's based on national security, they can impose tariffs without approval of Congress. That's the concept that allowed this to happen. And then following that, we impose import tariffs, everybody retaliates, and then they induce that as a way to have negotiations. So that's what's transpired in all these. I can't read all these numbers to you, but I'll give you the highlights. This was out of a Chinese newspaper, but this in July 18, that's when the United States imposed a 25% import tariff, and the Chinese immediately responded by imposing a 25% tariff on selected goods, notably agriculture and soybeans. And then if we flash forward to all of these events, the most recent event was October 11th, where the United States said we got an agreement October 11th, and that we would defer imposing a 25% import tariff, and the Chinese would begin buying more agriculture from the United States. So there's been a lot of tit for tat in the meantime, but that's the evolution. So let me speak to that. So here's the cast of characters. You should know them. And these are all advisors to the Trump administration. And as I read and do everything that I do, I think the way the Trump administration operates, they have advisors on both sides of any argument. They listen to all the arguments, and then they make a decision. And so on one side, on the lower left-hand side, we got Robert Lighthizer and Peter Navarro. They would be called what we might call the trade hawks. Peter Navarro is the one who wrote the book called Death by China. He's a Harvard graduate and said the best way to force somebody to negotiate is to put in place import tariffs. So he's the guy who invented the current trade policy of the administration. On the right-hand side, we have Secretary of Commerce Mnuchin and Lawrence Kudlow, who's the Chief Economic Advisor. They're also advising, but they're a little bit more moderate. When I say a little bit more moderate, they want to get a deal done. The hawks say, even if we don't get a deal done, let's fight this thing. So you got this tug of war telling Trump what to do. And so the major issues are the United States. We're very dependent on China. Like it or not, we're very dependent on them, particularly for manufactured goods. There's a lot of geopolitical issues that nowadays are very important, North Korea, South China Seas, and others. And, we don't really have an industrial strategy. I don't think anybody can articulate what is our country's industrial strategy. Many countries do. China does themselves. One of theirs is Made in China 2025. Another one is the Belt and Road Initiative. But the big issues on trade are the following. Chai won his election in 2010 as a communist, representing the Communist Party and growing up in the Communist Party, saying we're going to grow our economy by having SOEs, state-owned enterprises. So 70% of the commerce in China are state-owned, either federal or state-level enterprises that have favorable financial treatment relative to anybody else. The second one is their intellectual property. Mechanisms for protecting intellectual property is there. It's not as sophisticated as ours. So I'll tell you a funny story. Many years ago, I'm a visiting professor at a number of universities around the world, one of which is in Nanjing, China. Many years ago, we had a conference there, and I was there, and they had the people speaking. We had a panel and an audience like this. We talk intellectual property, that's computer software, automobiles, genetic modified technology. And somebody said, Mr. So-and-so, when are you going to begin protecting intellectual property? And I'll never forget these words. A long Chinese answer, a long translation. You know what he said? When it gets to be Chinese technology, we'll find a way to protect it. I'll never forget those words, and they're very true today. Okay, so those are the issues that are being talked about here. So, Trump really wants to have a deal, and kind of the way this evolved, the Chinese have been making concessions. They continue to make concessions on the things they can make concessions on, including they're buying more and more of our agricultural products. They reduce auto tariffs. They relaxed their genetic modification approval process. They granted trademarks to Ivanka Trump. They began downplaying this made in China story, the Silk Road story, but they've not done anything about state-owned enterprises. Internally in the United States, we got Trump and Kushner who want to get a deal done. And the hawks are really kind of saying, hold out, apply more tariffs, make them cave in on these industrial economic issues. So in June, I don't know if you all remember in June, but we had the G20 meeting, and I read all these newspapers. I never remember going into this, and Trump said going up to 3 days before the beginning of the meeting, he says, I'm going to meet with Chai in China, and I'm going to tell them we either have to have a deal or we're going to walk. So Trump is making these pronouncements. Chai had not committed to go into the meeting. So Trump says, I'm going to raise tariffs. Chai says, I'm not going to go to the meeting. So on Friday of that week, Chai communicated to the Trump administration, said, we will go to the meeting and we'll meet with you on these 3 preconditions, one of which is back off Huawei. The other is we'll buy more agriculture, but we're not going to commit to a volume, and we're not going to change our state-owned enterprises. And Trump agreed to that, and they had their meeting. So by the time we come around, I'm sorry, I missed some things here, but at that time, the United States said we were not going to raise tariffs for a period of time. We're going to restart our negotiations. And the Trump administration said China will buy a tremendous amount of food. I'll never forget a Saturday afternoon watching on TV. The Chinese said, 3 or 4 days later in the Chinese newspaper, that they will buy U.S. agricultural products if we quit flip-flopping on these negotiations. Imagine that. And they also said they will not buy in excess of what they need. So don't force us to buy something we don't need. And if we expanded all our imports from all these other countries, we may not need U.S. products. So these are kind of like 2 different stories on the same topic. So in July, Kudlow said he thinks they're going to start buying from us. This is July 11th. And this is a Chinese newspaper on the right-hand side. And they said that they denied making any explicit commitment to Buy American farm products during those discussions, instead saw large-scale purchases contingent on an agreement. So they said, if we get agreement, then we'll buy products. So those are kind of 2 different stories. So the most recent one was October 11th. It was a week ago Friday. I don't know if you guys all follow this, but it's pretty interesting the way it evolved. When I talk about this, because it's the one we're living under today, there's kind of the pretext and what the current terms are, and then how each of the U.S. and China has interpreted it, what are the implications for agriculture. And of course, on that day, Bloomberg comes out with, Wall Street Journal, on the front lines, trade war sinks North Dakota soybean farmers. North Dakota is more adversely impacted by this in agriculture than any other state in the country. So it's a big deal here. So going into the agreement, Trump's under pressure to get an agreement for ag, in part because he needs votes. He expresses that he wants a comprehensive agreement, including trade, state-owned enterprises, and intellectual property. He threatens them with tariffs. He's advised by some economists the day before, saying, look, if you put on tariffs, we're going to have a severe blow to our economy. And then Trump he concludes he wants to have a quick resolution to this, And he says publicly, China wants a deal, but I don't know if I do, is what he says. The Chinese going into this, the week before the Chinese were here and they were planning to visit farms and they canceled their visits. Nobody knows why, but probably because of the way the negotiations went. The Chinese want to be respect and fair and equal treatment. They had previously rejected proposals for agreement. They want a comprehensive agreement, but they're cautious that they're not going to cave on state-owned enterprises or intellectual properties. They'll buy all the agriculture we want, but they're not going to cave on those issues. All right, so then the terms of the agreement is that the United States would hold off, so we caved in on tariffs, and we would relax all of our bans on Huawei in the United States commerce. The Chinese were said to agree to buy 40 to 50 billion of agriculture, but nothing else was discussed. So it came into a lot of question, what does 40 or 50 billion dollars of agriculture mean? I'll come back to that. Trump says good things are happening at China Trade Talk meeting, warmer feelings in the past, and more like the old days. And then he goes on in the lower end, he says, it's the greatest and biggest deal ever made for Great Plain patriot farmers in the history of our country. In fact, there is question as to whether or not this much product could be produced. And the Chinese said, we made few concessions. We did not commit to buy $40 billion worth. And we have a limited deal. And now instead of a comprehensive deal, this is phase 1 of 3. So the press interpretation here says, Trump says China will buy 50 billion a year of U.S. agriculture. That's not what the Chinese say. So here's a Chinese newspaper called SubChina Weekly. Here's Trump holding the trade agreement. It's a blank sheet of paper. And this came to be called the invisible deal because it was talked about as a deal, but there was no deal and there was nothing signed. So this 40 to 50 billion in agriculture is really important. Yeah, but there was a question when this first came out. Is that 40 billion, that's twice as much as they normally buy from the United States? Is it over 1 year or 2 years or multiple years? And Mushin finally said that it would be ramped up over time. The Chinese had not confirmed those values, and they iterated that it depends upon their demand from China, and they have existing purchase commitments from other countries, and it depends upon how competitive the United States is relative to other countries. So these are two radically different interpretations. So what was resolved in the past few days is that the specialists will draft an agreement. They will get together and meet at the November 16th at the APEC meetings, and they will sign an agreement. Then they will commence to negotiate phase 2. But the Chinese have now said in the past couple of days that before they commit to buying this much, they want to renegotiate tariffs. Because there's another tranche of tariff increases that are scheduled to go up in December. And I'm sure the Chinese are saying, we will agree to that, but we haven't agreed to it yet, but you better lower tariffs some more before we agree to that. So here's a Reuters story, and this shows the Chinese imports of agriculture from the United States. The most they ever bought from the United States is 24 billion. So if you say 50 billion a year, that's a lot. Okay, and so the commentary says, I think this is a meaningless number thrown out to get headlines and won't happen. So just drawing conclusion. So the impacts on U.S. agriculture and farm are very, very important. I'll show you just 3 slides. These are from a colleague of mine who does work in ag finance. I'll give you his contact in a moment. So our peak time in North Dakota agriculture is really 2012 to 2014. Prices were high, costs were low. Since then, costs have gone up and prices have gone down, and you can see the gap now on the right-hand side. This shows the state net farm income in our state. The red line is on average, and you can see we peaked out in 2012. It's been declining since then, relatively flat going into 2018. And here's his punchline. He does a lot of financial calculations and bond rating. And on the left-hand side is the Moody's bond rating scale. And those other lines are the 5 groups of farms in North Dakota. And what you can see is the yellow line is the top 20% of net income farmers in North Dakota. They would be relatively well-positioned going into the coming crop year. All other categories are going to be downgraded substantially. So this is not completely firm yet because things are changing all the time and markets are changing. But this is what he's showing today in his extension conference, and it's a bit of a caution to the banking community about the financial importance of the decisions farmers are going to be making with their lenders. This is his name, Brian Harman. If anyone wants to contact him, he can send you his whole slide deck if you like. Agribusiness is also being devastatingly impacted. I do a lot of work in this sector. It's interesting, when we had the Russian grain embargo, there was a subsidy to farmers and to the grain handling industry. In this case, there's a subsidy to farmers, but not to the grain industry. So you can see on the right-hand side, this is revenue growth of the ABCD, Archer-Dana Midland, Cargill, Bunge, and Dreyfus, and CHS in there. And you can see, follow 2012, their revenue growth fell pretty substantially. And in the past year, it's falling quite substantially again. On the right-hand side is the ROI. For all companies, it's been declining, and generally speaking, would be considered to be subpar. The best one is averaging about 7 or 8% return on investment. All of the others are declining and less than that. So I'm going to just have a couple slides here and then I'll stop and answer some questions if you have it. I think the challenge for us, ultimately we're going to get over this because we can't continue it forever, I don't think. But we are coming to be called a not reliable supplier. And this is very, very critical. And we have been labeled this in the past, and it's not reliable because we as a government have used trade policy in one way or the other to intervene in the market and create problems. Soviet grain embargo in the 1980s, Brazilian European poultry in 2009, 2013 when we had the pre-release or premature release of a GM trait that wasn't approved in China. Prior to then, China was our biggest importer and expected to grow to be our biggest import. Today, they don't buy anything from us. So we're coming to be labeled that, and I'm pretty seriously involved in this. This shows corn prices from every origin to China, delivered China. It's in basis terms with ocean rates. So you can see on the bottom side there, the cheapest origin for corn to China is the U.S. Pacific Northwest. That's North Dakota corn, cheapest. Most expensive is Ukraine. How much do they buy from the United States? Zero. They buy 100% of the corn out of Ukraine. So they, because of government intervention, are intervening to force purchases away from the lowest cost source of supply. I don't know how we're going to overcome that in the case of soybeans. So one of the implications of all of this is increased volatility or increased risk. And this is being caused by extreme government interventions in the case of China, in the case of the United States, but not just the United States, it's Canadian canola, same case, the same thing is going on. We have extreme Russian interventions. The Russian government now is getting into the grain exporting business by acquiring a railroad and a couple of the major port elevators. And the effect of this is increased volatility in markets. So just think if we go forward with China and negotiate this over the next 5 years, and we keep on making these interim agreements where Trump is going to hold a tariff over their head and they're going to hold a tariff over our head. It's going to create an extreme amount of volatility in prices, bases, and trade flows. The impact of that ultimately is to detract from investments in agriculture and agriculture technology and agriculture farming. So last slide, I guess I should say something probably, what does that mean for you as bankers? I think it's really important to understand the structural environment. We have a very robust growth in demand, and increased differentiation was good. We have a lot of new technology coming in agriculture. You see it in soybean yields and cost of production. Now we're going to have driverless tractors and all these new gene-edited traits and the Impossible Burger and Beyond Burger and all these things, which is all great differentiation, great for agriculture. But we have a greater amount of intervention into this marketplace than I've seen in my career. That started in 1980, before many of you were born, okay? So we have all this Trump and China and Brazil and Russia where they're intervening, and that distorts these sources of competitive advantage, which we otherwise should have. We are more intensely competitive in rivalrous marketplace now than ever before, whether it's between countries because of Brazil, Russia, Ukraine, or whether it's between companies in the commodity market business. We used to say A, B, C, D control the world grain market. Now it's A, B, C, D. plus Kafko, plus Gavilon, plus Glencore, plus 15 Russian grain trading companies. So now it's intensely rivalrous. So the impacts of soybean, I suspect the loss of China as a primary market is very serious. It's going to be more risky. We will probably become more dependent on government programs, and it's probably going to last 3 to 5 years. There's going to be extreme pressure on the farm sector. Maybe this is the bottom line for you. And what does that mean? It means those farms that are low cost, that are appropriately adopting technology, and that are financially well managed will survive because they have to. We need commodities grown in these farms and they'll survive. But the others are going to have a difficult time, and I think that's apparent in the slides that I show. With that, I think, Gary, I can take a few moments of questions. Shane, if there are some questions or comments, or if you want to say something nice.
So we'll go around the room. We do have a few people with mics. If you have questions, raise your hand, and we can get those out.
I think there's tremendous opportunity in agriculture. There's tremendous opportunity in this country and in this region of the country in particular. But those opportunities are substantially lessened when we have these types of interventions, because we're very, very adversely affected relative to the rest of the world, and we in this state are more adversely affected relative to other states in this country. So the sooner we get these interventions behind us, the faster we will regroup to a place where we have a big advantage. So maybe now you can ask a question.
I actually have a
Yes.
question. You had said, and this has been something that's been on my mind for about a year and a half, and in your talk you even spurred my curiosity about this. My question and concern is, with the current trade situation and ag just in general, what I haven't heard is the impact on grain buyers and what is the economic strength or strain on our ag buyers, such as elevators on a small or regional or national level.
So good question. My perception, if you look at the whole value chain in commodity trading from farm to export, probably the one that is most well off is the agriculture buyer sector that you refer to. Now, whether that's small or big can be debated, but you know, we have very efficient shuttle elevator system in this country, about $35 million a pop. They can operate at low cost. They get 10 to 20 turns a year. That's substantial relative to elsewhere in the country and elsewhere in the world. Typically speaking, they're handling ag inputs, and I think there's substantial revenue stream related to ag inputs. So I suspect that sector is not as devastatedly impacted relative to the others. The farmers are adversely impacted, as you saw. The grain exporters are adversely impacted because they have assets in this country and trade is shifting to other countries. So they say, fine, go to Ukraine and invest. Well, that's not such a rosy deal. They have assets here and they'd like to operate those assets. And so if we take away volume of trade from those export traders, they're not utilizing those assets. So my guess, I think the financial strength of the shuttle elevator system in this region of the country and nationally is fairly well off. Obviously, they're impacted, but not as devastating as the other parts of the supply chain. Okay, other questions or comments? Yes, sir.
Are there no buyers for stored beans, or is it just too low of a price?
No buyers for stored beans? Yeah, so because I think I understand, Gary, let me take a whack at it, and if not, tell me and I'll try it again. So one of the impacts in the marketplace is we have lots of storage in this state in particular. We have enough storage space for storing 2 to 3 years worth of crop. That doesn't exist in other countries, Russia, Ukraine, Argentina, or Brazil. They got to sell it when they produce it because they need the money and they don't have storage space. So the other phenomenon that's important is we have, in the futures market, we have a very large spread from the nearby to the deferred. So they can make pretty good money by storing from the nearby into the deferred. So when I say deferred in this case of soybeans, that's probably January, February, March only, okay? So they can be making 20, 30 cents net return from that type of storage activity. So as a result of that, they're typically speaking not selling because they're making money in storage. Does that answer the question okay? Yes. Other questions or comments? Yes, sir. Go ahead.
Test 1, 2. Check. Test 1, 2.
So when this was first, and I don't know exactly the answer, but I know what we're thinking. When it first occurred, everyone kind of thought it was a one-year phenomena. But I'm on the board of a company that's a very large supplier to this. We had an expert come in and he said, this is going to last an extended time period in China because they don't have contained feeding like we have. If that happened in this country, we would isolate the farm, we'd treat it and so forth and quickly resolve the issue. In China, it's a bunch of mom and pop farms with a half a dozen pigs in the backyard. So there's carryover in the land and in the pigs. So we were told it would last 5 or 8 years. So that's the answer I'm going by. And since then, it's been spread to South Korea, North Korea, and to Eastern Europe, Poland, and Romania. And it's a big challenge for us to keep it out of this country. And what I read is we're effective at that so far, but it's a big challenge. It's a very serious issue. Other questions or comments? There was another one over here.
Yeah, my question is around ag real estate values. You know, things aren't as rosy as we were talking maybe a year or two ago for the ag recovery, and we were thinking ag real estate values wouldn't take the big dump they did in the 80s. With this more negative outlook in the next few years, are you thinking ag real estate values are going to take a bigger hit?
So they're not going to be upwardly robust as one would like. This is what Brian said. He says, the land market's weakened, but mostly will hold their values since their peak in 2014-15. Okay, so the market is still holding its own. It's not crashing, but there's a threat that it could crash. Fortunately, we have that top 20 to 40% of the farmers with fairly good incomes, and they will probably be supporting land values. So I don't know exactly the answer, but I know we're not going to enjoy the growth in land values that we've experienced in the past couple of decades. In this part of the country, compared to elsewhere, we're probably going to have a little more strength. If you look historically, I'm on a venture capital fund board, and we have $500 million invested in farmland. And if you look at the growth in farmland values around the country, North Dakota has experienced the fastest growth in farmland values. You want to know why? Because farmland values escalate the most when you adapt new technologies. So when we converted much of our land in North Dakota from cereals to GM row crops, that increased productivity, increased profitability of farms, increased the value of farmlands. And for that reason, the farmland in Iowa is more valuable. The growth rate in farmland values has been greater in North Dakota because of the adoption of new technologies. Now, whether or not the extent that happens and continues in the future, we'll see. But that's one of the reasons why in this part of the country, we've been supported at higher values than higher growth rates than the rest of the country. Other questions? None?
Any other questions? All right.
Okay, thank you very much.
Thank you very much.